Hello, and thank you for joining me for the 2025 recap and 2026 outlook. This is Joe Mass. I'm your Chief Investment Officer for Synergy Asset Management. We have a lot to cover, so I'm going to try to go fast, try to keep it simple, uh, and unpack it. You also can request a copy of these slides so you can take a time to look at them more closely. And we will also be putting out a couple written pieces for you to review. So we will have a 2025 recap and a 2026 forecast paper that will be coming out shortly. So make sure that you look for those. Okay, let's take a look and see what we got. So starting off with our market cycle, we have a proprietary model that we look at on a continuous basis. We're looking at fundamental data, economic data, and technical data. And this kind of guides us on how we make decisions. And so at the beginning of the year here, we're about 77% bullish, meaning we think the market is more likely to go up than go down, with a bearish score of 23%. Now, caution here is that sometimes when these numbers get too high, there can be a mean reversion, meaning that the market is overbought and can pull back. But going into the year, things are looking pretty good for 2026. We don't think it's going to be a straight line to the end. We do think there's going to be some volatility, and we'll talk about that as we go through today's presentation. Looking at the regions, hey, there was a lot of participation around the world. Latin America came in at number one spot. Europe did well, emerging markets. In fact, you look at down there at the U.S. stocks as represented by the Russell 3000, they did a little bit over 17%. So there was lots of risk-on opportunities around the globe in 2025. When we look at the S&P 500 back here at home, we had about a 2.35% return for the quarter. You can see the red circles that the S&P 500 broke its 50-day moving average, which is a bearish indication. You can see this pullback. That happened twice throughout the quarter, but we did end up and on a positive note. When we look at supply and demand, as you've been watching our videos over the year, you know everything is driven by supply and demand. So what we want to see is that this black line is above the red line. That means that that's good for the market, and you can see that the black line was above. We had a small little dip here where this the kind of the bears came back, and then we ended the year with the demand side of the equation still in favor. And so that was good for the U.S. equities. When we're looking at sectors, again, we can see that technology did very well in 2025 and in that fourth quarter. The best performing asset class in that fourth quarter of 2025 was healthcare. And it also had a pretty good 2025. So that the column or the table that you're looking at here is ranked by those 2025 total returns. So that's why you see technology, communication services, industrials for the top three sectors, then the S&P 500, utilities, and so forth. So we did have some broad participation. For the year, there wasn't a sector that was down. Consumer staples came in at 1.56%. Now, there's a different story for the quarter. There were sectors that were down. You can see real estate was down in the fourth quarter, just a little over 3%. When we turn to asset classes, wow, silver and gold and metals, they were the story of the quarter and of the year. Over 147% in silver. And we talk about metals being either an offensive player or a defensive player. Right now, they're still on offense. The metals and gold and silver have really been providing a lot of return, and many expect that trend to continue. So again, lots of participation. We saw emerging market equity debt do very well. Developed international markets did well. Large cap growth, NASDAQ. Again, international bonds came in at the end of the year at about 3%. So strong asset class performance outside just the U.S. and the S&P 500. When we look at the S&P 500 and the breadth for the quarter, you can see that 244 companies were up, 267 companies were down, and on the left you can see that the majority of the usual names were providing the return to the index, the Alphabet, the Apple, Micron, Nvidia, Broadcom. So it's really been a year of concentration. On the other side, you can see for the quarter, one of the darling stocks, Microsoft and Meta and Netflix and Strategy there at number 6 really pulled the index down. Okay, so we expect Microsoft and Meta to perform well, but last quarter they did struggle. When we look at the breadth of the S&P 500 for the entire year, it was up about a little bit over 16%. 335 companies were up, 204 companies were down. Now again, here we see NVIDIA, Alphabet, Broadcom. Now we see Microsoft back as a leader for the year. It just had a rough quarter. Apple, Eli Lilly, and JP Morgan. The big return detractor for the S&P 5 last year was United Health Group, and then Pfizer, Salesforce, Accenture, and Procter & Gamble. So that leads to the question is, are the markets overvalued? The top graph is looking at the S&P 500 on a forward-looking PE ratio. So the PE is a crude measure of valuation. So looking at this chart, the current price is about 25.66, which is considerably higher than its long-term average of 20. So this would indicate that the market as a whole is a little extended. The equal weight index tells a different story. If you're looking at each company in an index contributing on a pro rata equal basis, or an equal basis, not really pro rata, then it's right about average. And so there's probably some more value to be seen there. And we'll have some more slides on this coming up. So valuations are probably extended at the index level. But again, with focused investing and concentrated investing, we're always looking for the companies within that broad index that are going to have some, above average potential in any given year. And so that's what we will continue to look for. When we turn to the economy in the recession, we again have a proprietary economic model that we like to look at. At the end of the year, again, we're pretty much 76% bullish, so very low probability of a recession over the next 12 months. And as we look at the cycle, we still think the economy's trying to kind of just stay at this midpoint and skirt over. It's not pointing down to a new low. It's not really rushing up to a new high. It's doing well. Are there concerns? Of course. But we are moving over. I think we're just trying to skirt over this midpoint. So one of the things that we like to look at that we find most probative of a recession is the relationship between the unemployment and the change in unemployment. So here what we see is the green line is the pure rate of unemployment. And there's no one level that is indicative of a recession. So again, these red bars are recessions, and you can see that they've happened throughout the years at different points on this green line. So it's not the same point. What's more interesting is maybe that second derivative or that first derivative of this data, and that's the rate of change on the data, and that's this blue line. And so you can see that when the rate of change of unemployment spikes from being down to up over 1, that those red bars appear. So will that happen in the future? We don't know, but it's been a pretty good predictor in the past. So if that trend continued, we can see that unemployment has ticked up just a little bit here, but it's not past the danger zone. So we're still watching that, okay? If we look to the yield curve in a recession, a lot of people like to say, hey, listen, the yield curve turns negative before it turns positive, and it's once it turns positive again that a recession follows. And so this chart is showing that logic. And so you can see here the yield curve was down, it turned back up, and we got a recession. Same here, it was down, positive, and then we had the recession. Negative, positive, then recession. So you can see here that we've been negative. We had an inverted yield curve, which just means that the short-term rates are higher than long-term rates. And once it gets back to a normal shape, where long-term rates are higher than short-term rates, we'd call that a normal situation. And we don't have a recession yet. So this is one piece of evidence that the people want to say, hey, there's going to be a recession coming. This is a piece of evidence that they would use to make that argument. When we look at the economic indicators, up here we have the road. This is where we're going. These are leading in economic indicators. These are where we're at, coincident indicators, and these are lagging indicators. So right now the leading indicators have still been down, but without a recession. The coincident and the lagging are both positive, okay? And this red line here is the road that got us there, and this is the Federal Reserve. So this is kind of like looking out of the windshield of the car, the green line. The blue line is like at a stop sign and you're looking out of the side of your window, and the orange line is like looking through your rear view mirror. So we want to pay most attention to this green line. The red line is the road that got us there. That's the Fed rate cut cycle. We'll talk more about that, but as you probably know, rates came up, they leveled off, they started to come down, they've plateaued, and they're expected to continue, and we'll talk more about that in a few slides. When we look at economic activity, again, looking out of the windshield of the car, looking forward, we want to look at the blue line and the green line, which are the ISM manufacturing and services indexes. And what we would like to see is we'd like to see those indexes above that dashed red line. That means anything above 50 is expected to be an expansionary indication, and anything below that line is expected to be a contraction in the economy. So hovering at 52.6 and 47, they're not too bad. They're right about positive. So those are still pieces of economic data that we think bode well for not having a recession over the next 12 months. If we look backwards at GDP, so if we look through the rear view mirror of the car, GDP came in even stronger than expected here at 4.3. Most of the quarters have been positive, a few negative, but again, we've had a pretty strong economy. On this bottom panel, we see the white line is the S&P 500, and we see that it's continued up, and the rates have leveled off and come down. So that makes sense. If rates are coming down, we'd expect that white line to be going up, and that's what we're seeing. Now, if we look at the Bloomberg survey of a probability forecast over the next 12 months, it's only at 33%. So again, a very low consensus estimate of a recession over the next 12 months. If we look at the smooth U.S. recession probability forecast that's put out by Fred, you can see that it's quite low. Now here, this isn't a 0.94% probability of a recession. This is their scaling methodology, but you'll see that here on the chart it is extremely low, and these gray bars represent those recessions where the blue line had peaked. So we don't see this blue line peaking. So again, another piece of evidence that the Fed data isn't expecting a recession over the next 12 months. So what's driving the market? Well, we know what happens. There's bull markets and there's bear markets, right? And those are driven by interest rates, inflation, corporate earnings, the Fed, and geopolitical events. When we're looking at inflation, the PCE has been about 2.8, so it's been low. The expected inflation over the next 5 to 10 years that's put out by the University of Michigan is at 3.2. And then the median 1 year inflation expectation based on the University of Michigan median is about 4.2%. So inflation might pop up a little bit, but all in all, it's been coming down and it's relatively low, and that's positive for equities. The interest rates, end of the year, just about 4.2%. The 10-year has been going up and down, but right now, that's a good rate for the market. That shouldn't start a bear market. Corporate earnings are above average and been very resilient. So again, this year, earnings are expected to be, above 10%, so that should bode well. The big change this year is going to be the market's expecting the Fed chairman to be changed out. So there's going to be a lot of uncertainty around that, and so there's probably going to be an adjustment period to see what the new Fed chairman is his strategy is going to be. As far as rates, are they going to go up? Are they going to go down? Are they going to hold stable? So we are expecting that to be weighing on the markets, and there will be a lot of discussion around that. So the Fed did start cutting the end of the year at 3.5 to 3.75% of the Fed rate, and it's estimated to be just a little bit above 3% by the end of 2026, but we'll have to wait and see. So again, this is something we are watching. There will be some uncertainty and volatility around the Fed action here. Geopolitical events, the markets have been really resilient, and they kind of are just blowing off all types of geopolitical events. So right now, we don't see that type of event really weighing on the markets. This year, we did see the Venezuela takeover, not really takeover. What was Venezuela? Looking to get Maduro for charges, crime charges, or war crime charges, and the markets really went up on Monday. They really didn't react negatively. So again, geopolitical events have been not an adverse effect on the market lately. When we look at the yield curve, what's interesting is you can see that the long and the short end, don't move in the same way. And that's why you hear in the news that there's a twist or there's a steepening in the yield curve. So what we can see here is a year ago, rates were higher, okay? And then 3 months ago, and then current. So you can see that that short end has really come down quite a bit, right? We've seen that movement on the short end of the curve. When we look at the long end of the curve, you can see that the movement hasn't been severe. So rates don't move equally along the curve, and this is why it's gotten steeper, right? This blue line here, this dark blue line, is a lot steeper in shape than this line here. Okay, so the short end has had more movement downward than the long end, and rates are expected to come down, right? The Fed, but they don't. Movements in rates don't treat both ends of the curve equally. Okay. Market factors. So high yield bonds have still been outperforming investment grade, and we see that line in trend continuing there. If there's a flight to quality, then we would expect to see that the investment grade bonds would be outperforming the high yield bonds. High yield bonds do track more with a risk on asset, and so this makes sense if we've been in a bullish market that the high yield bonds would be highly correlated to that movement. Predominantly, we've had large cap over small cap, but we did see a little tick up in small cap, and we'll talk more about that in a few minutes. When we look at growth versus value, we can see that growth pulled back a little bit. If this green line was going up, that means growth is in favor. If this green line is going down, that means that value is in favor. And so you can see here that the green line has been going down and that value started to perform well over the last quarter. Momentum again pulled back just a little bit. So we did see that, here's the starting of the quarter, here's the end. And so it is pretty flat, but you can see from September down to December, we see a trend down. So not a big movement, but that value, like we saw on the prior slide, was coming back, and that overgrowth, and that's the same with momentum. When we look at the international markets, U.S. equities had a small pullback, as we saw in the beginning regional chart, but we still like the U.S. equities, and we do find a lot of valuation in the international equities. So having a diversified portfolio that contains both U.S. equities and international equities is still probably a good strategy. When we look at the market weight versus equal weight, we can see capitalization weighted trending, but pulled back just a little bit, and we'll look at another chart here. Okay, so again, the big companies have been in favor, but the small cap companies did come back here at the end of the year. So on this chart, we can see this come to life. We can see that here's each sector of the S&P 500, and it's comparing the market weighted return versus the equal weighted return. And so down here where my cursor is, we can see that year to date that the equal weight is in favor versus market cap, and that's been the case over the 1 week, 4 week, and 12 weeks. Okay, so here again, there's that recent performance has been in the equal weighted, but long term, that market cap has still prevailed. Okay, down here. So it's nice to see equal weight coming back and some more stocks, getting away from the highly concentrated Magnificent Seven. But again, for the year, those large companies did prevail. Okay. So what's the outlook? Well, we're cautiously optimistic over the next 12 months. You can see that we got bullish and neutral kind of indicators on U.S. equities, international, emerging market. So we do have positive forecasts on the market, which we'll show you in a few slides. But we're still neutral. We're not ready for a brand new raging bull market. We've been in one. The market's been up for 3 years in a row. But there is still evidence that says, we could have. It's not going to be a straight line. We can still see. Some pullback. There's still some volatility there. So it's not going to be a straight line. So U.S. equities, we have growth over value, small over large. We think the NASDAQ should outperform the S&P 500. Mid caps are going to be lower than large cap and small cap. And then U.S. It should be performing over international markets. We'll have emerging markets over developed markets. So those smaller, undeveloped companies are probably going to outperform the larger companies. When we looked at fixed income, it's stable. It should be in a diversified portfolio, in our opinion, right now. So we do like fixed income from that perspective. And then U.S. real estate, it's struggling a little bit, but lower rates would really be a positive. So if we do continue to see rates come down and the 10-year come down, that's going to help homeowners. So we'll just kind of wait and see on that. Again, we're kind of neutral. When we look at some forecasts, it's always fun to kind of predict the future, even though it's impossible and no one can do it. We always try at the beginning of the year to see how we did. And so here what we're looking at is the top-down estimates from several of the large strategists on Bloomberg. And you can see up here, Oppenheimer has the highest target of the S&P 500 at 8,100. The BCA Research has the lowest at 52. Synergy Asset Management right here, we're at 73.35 by the end of the year, and that represents about a 10.62% return. So we have a high, we think we could be as high as 79.15 or up almost 15, and we have a low that we might be about 7.68. Now we definitely think that the market could have a negative return, but in forecasting we want to stay on the positive side, and we'll talk more about the negative side in just a second. So again, it looks like it should be an above average year of market return. Even the average return of the analyst comes in at about 8.24%, and again that's higher than what we assume the market can do at a long-term average of around 7%. So again, the returns in the S&P 500 look to be above average for 2026. Again, will they go in a straight line? We don't know. Will they end up there? We don't know, but this is what the fundamental data is showing at the beginning of the year. Now we look at this ugly chart here. This is the VIX. The VIX is just talking about volatility, so we can use volatility to look at both the high and the low. And so you can see that based on the VIX, the market should move about 14%, almost 15% over the next year. The problem is we don't know what direction. If it goes down, the market would move down from 6,900 down to 5,900, and if it moved up, it would be up at 79. So that's kind of the range based on the VIX. The range based on the volatility of the S&P 500 itself is just shy of about 9.5%. And again, 9.5% down would be 62.56, and 9.5% up would be 75.67. So is it possible for the market to go down or 10 or 15%? Absolutely. But that's not what's forecast, but that is within the range of reasonableness based on volatility. When we're looking at sectors, our number one rank is going to be energy right now, materials, financials, and then telecoms. So these are based on a 4-factor fundamental process. So we're looking at the forward-looking PE, then estimated earnings per growth, the price to book, debt to capital, and then we rank and sum those. And so again, based on this, energy looks to be a favored sector for 2026. When we look at asset allocation, we ran 5,000 Monte Carlo simulations on what we would call a moderate portfolio or a max Sharpe portfolio. And so 90% of those observations, so 90% of the time running those 5,000 simulations, the return landed between about -10 to 20, about 24. So 9.6 and 23.5 to be exact. And on average, that was about a 6.85% return. So that's kind of the range that we're expecting for asset allocation. At this point in the cycle, these are the allocation cycle guidelines. So for a conservative investor, you'd have about 35% stock, 50% bonds, 15% cash, and no allocation to commodities. For a moderate investor at this point in the cycle, you might want to look at something like 65% stocks, 20% bonds, 5% cash, and 10% commodities. And then for an aggressive investor, 75% stock, 15% bonds, 5% cash, and 5% commodities. Remember, these are not investment recommendations. These are guidelines for you to talk with your primary investment advisor about and make sure that they're right for you. But again, everyone likes us to forecast and give them some guidelines, and so we do that for your edification and for your further discussions. Okay, if we're going to look at a recap of 2026, and again, I apologize for a lot of words on on these slides. We'll give you the recap, and of course you can read these slides later, as well as this information will be in our forecast paper and in our recap paper. So inflation, inflation is no longer the primary headwind, but it still remains a latent risk factor influencing policy and valuations. And so there is potential for a little higher inflation that we talked about earlier based on the University of Michigan. But again, it's not the primary headwind. The Fed, and we never want to fight the Fed. We want to respect the transition, right? Monetary policy shifting. And again, we just really have to wait to see what happens. But I would give it a probably increased probability for lower rates if I had to guess one way or the other. Interest rates, the yield curves normalize, but remember, based on the chart we saw earlier, it's not a green light. We still have to wait and see. Duration management and curve positioning, as we saw in our other chart, will remain something that we need to be intentional about. Again, that's looking at that long-term and short-term end of the curve. When we're looking for active management, again, last year was very difficult. About 75% of managers underperformed their benchmark because there was such a large concentration in those Meg 7 or stocks. Okay, so there was a lot of concentration up there, but we do think that'll broaden out as we've been seeing with the evidence of the equal weight coming back a little bit better. So again, we're still excited about the active management opportunities. When it comes to the mood of the market, the investor sentiment, the AAII investor sentiment has been kind of oscillating. It's bullish but fragile right now. So people, I think, are going up and down. It's kind of like a roller coaster emotionally. So again, we see that oscillation. But again, I think as we've written here, it's reflecting an investor base that's participating reluctantly rather than euphorically. When it comes to fixed income, again, it's there for stability, for income, and a risk-off characteristic in the portfolio. Fixed income markets have stabilized and continue to offer meaningful income right now, diversification and downside protection. So again, we like fixed income in 2026 for a risk-off asset. Corporate earnings have been resilient with selective risk, right? So those corporate earnings have been notably in certain sectors, and so some sectors and some companies really have those strong balance sheets and margins, but we still have to look both at a broad index level and a company by company level for input costs such as those wage pressures and tariffs and inflation and things of that nature. So I think really you got to be looking at each company one by one here is really important when it comes to understanding the earnings durability of each company. The geopolitical front, and there's persistent noise, right? But it's been limited impact so far. So they have not materially derailed the markets, and it's probably because they've gotten desensitized to all the global tensions. So that said, events remain, geopolitical events remain a tail risk. So we still have to worry about them. Unfortunately, we don't know what they're going to be before they happen. Like no one knew really about Venezuela until it happened. So we will continue to watch those, but it's hard to forecast geopolitical events. But luckily, recently they haven't appeared to be weighing on the market or derailing it. Valuations, again, full in some areas, right? And reasonable in elsewhere, like we saw from our prior charts. So, large cap and AI, those have been the themes of the overvaluation. But other parts of the market, value, dividends, small caps have performed very well. International equities offer attractive, entry points. Future returns are likely to be driven more by earnings growth and capital discipline than that multiple expansion in 2026. As we've been discussing, that market concentration risk, really a small number of mega cap companies continue to account for disproportionate share of the index return. So we've seen that. We also wrote a paper on that here recently. If you haven't received that, just ask your advisor. Private credit, I'm just going to say that private credit has been on our radar. It's a very complicated area. We don't really allocate anything to private credit across the board at the moment. So I'm not going to read each one of these. I just want to let you know that private credit is something that's been in the news and that is definitely on our radar. but it's pretty complicated. I'm just not going to go into it. Again, I just wanted to let you know that private credit is something that we're looking at and paying attention to. So portfolio construction takeaways. 2026 is shaping up as a year where risk management, diversification, and active decisions in portfolio allocation is going to be, more important than trying to time the market, right? So that's what we're looking at. We're looking at to be patient, diversified. We're not trying to time the market. And again, the probabilities for the market to be up by year end, but with a cycle down first. So a lot of the cycle work that we're looking at and some of the technicals, could indicate that between February and June is a down market. So kind of like in 2025 where we saw, that market really pull back in April and then had a V-shaped recovery to end the year strong. That could be a similar pattern this year. And so what we're going to talk about throughout the year and what you need to be thinking about is, are you going to want to stay invested, or are you going to try to go to cash if there's a downturn? Because timing the market's impossible, right? Predicting the future is impossible. And if we look at 2025, it would have been better to have just held on to stocks and not gone to cash and not made any changes in April, as opposed to making changes and trying to get out of that downturn. So, being patient with volatility is difficult, but in 2025 it paid off. So in 2026 it's probably going to again be that storm before the calm. We believe that the market will be good by going into it. There's a lot of positive things that we talked about: inflation, earnings, the Fed, and interest rates, but it's not going to be a straight line. So that short-term volatility, policy uncertainty, and sentiment-driven pullbacks are likely, right, as the market recalibrates expectations around interest rates and economic growth and leadership and the Fed. So, history suggests that transitions, usually precede a more stable, constructive market condition. So there's going to, again, probably some volatility before it calms out. So that's the storm before the calm. So again, let's be disciplined, let's be diversified, let's focus on fundamentals, let's have our parachute before we need it. We're going to manage risk proactively as opposed to reactively. So going into the year, you want to make sure your portfolio is positioned, for your both your willingness and your ability to take risk, and then adjust, if you have material changes in your investment policy statement or in your ability and willingness to take risk. Okay, so we still think it's going to be a pretty good year, but it's not going to be a straight line. So what do you do as clients? Well, you hold enough cash to make you comfortable so that you can withstand or survive the V-shaped or the down parts of the market, and you can survive for the upside till the V-shaped recovery happens. So hold enough cash to make you comfortable. Evaluate your time horizon and your other investment policy factors, right? If you're looking to use your money over the next 30, 60 days, you want to take a different approach to investing than if you're looking at the next 3, 5, and 10 years. So make sure you're looking at that investment horizon. Make sure you communicate your changes and your objectives to us so that we can update the portfolio as necessary. Please be patient. Again, investing is a long-term game. It's there's going to be always periods of volatility within the month or within the year. So again, you have to be patient. What we're going to continue to do is we're going to continue to listen to you and adjust portfolios allocations as necessary based on each one of your individual needs. We're going to manage cautiously via a data-driven process, right? We look at the preponderance of the evidence. We're not just looking at timing the market, or we're not looking at emotional decisions. We are looking at data and letting those processes drive our decisions. So once we've investigated and analyzed, of course, we're going to communicate. So we will communicate and then monitor and adjust as necessary. Okay, well, thank you so much. That was our recap. The last 35 minutes. I'm glad it didn't take an hour and a half. We do have some written materials for you to review, so those will be coming out. Again, look for a 2025 recap paper, a 2026 forecast paper, and continue to watch our monthly videos and our weekly writing. So we try to communicate with you throughout the year. and then of course give you a little more in depth on a quarterly basis. So thank you so much for your trust. Thank you for being clients. Thank you for spending the last 35 minutes with me. And let's go out and have a great 2026. We'll see you at the end of the quarter. Thank you very much.